Well, good morning, everyone, and Happy New Year. We're about 3 weeks into the year, and it's a good day. It's a good year. We're looking forward to a positive 2021. It's good to see you all again today, and thank you once again for joining Pattern as we kick off our monthly housing webinar series for 2021. Our housing webinar series has been generously sponsored by NeighborWorks America, and my deepest thanks to that organization. The last time we gathered as a group to discuss the housing market was in November during our Housing Week Shelter from the Storm. We discussed the facts and figures about the first 3 quarters of 2020, including prices and inventory and a shifting demographic from New York City to the Valley. Today, I'm happy to be joined again with Joe Rand, Bill Calderara, William O'Keefe, Paula Kay, and Greg Langer. Our world has continued to change, and the impact of this pandemic and the political strife has hit the boiling point. There's a lot of anxiety and fear for many people today, and housing certainly plays an important role. I would like to focus on homeownership and the real estate market for today's webinar. I'm going to go around the Zoom square and ask each of you to respond to a few questions. Let me very briefly, set the stage. We're anxiously awaiting the New York State Association of Realtors to release their annual data for 2020. We'll be examining those numbers and releasing our annual report at the end of the month. Even without the specific data, we all pretty much know the results. Home prices skyrocketed in 2020, inventory was way down, homes were bought sight unseen, interest rates were at historic lows, and the data indicated an influx of buyers from the New York City area. Realtors used virtual tours to show homes and closings, and it took on a very different look. There were drive-through tents and electronic signatures. Not only were banks busy with new homeowners, but the refi market was busy as well. So let's start by drilling down a bit in terms of housing inventory and sales, types of transactions, developments, volumes of closings, and appraisals and lending. Let's start this morning with a regional perspective from Joe Rand. Joe, what's your read on today's pricing, inventory, and the seller's market? And specifically, what are your thoughts on urban and suburban markets versus the rural areas? And lastly, are the lower priced homes jumping in value as much as the higher priced homes? So I know there's a lot of questions and sub-questions in there, but I'm going to turn the floor over to you. Thank you, Joe.
Thank you, Joe, and thank you all for having me. It's an honor to be participating in this again. Yeah, the housing market in 2020 was really a volatile whipsaw. It just kept changing. We had the first quarter was very much a continuation of what we saw in 2019, which was kind of a growing seller's market. Prices were going up, sales were going up, inventory was going down. And then, of course, when COVID hit in mid-March, the market completely shut down for a couple of weeks as people were locked in and they were trying to adjust to this new reality. And then in the second quarter, which was mostly the latter, April and May, and then a little bit early in June, before the market opened up again, the essential services order lifted. Obviously, there was a lot holding the market back with the essential services orders, with the fact that there was a public health crisis. People didn't want to show their homes. People don't want to go look at homes, quite understandably. But what was surprising in that was how the market did not fall as much as we would have expected in that kind of condition. If you mind if I show a slide here that will show you how the market changed over the course of this time, you can see that in the first quarter, the red numbers indicate numbers that were down. First quarter, sales were up in closings, prices were up, pendings were a little light, and listings were a little light compared to the first quarter of the year before. And then in the second quarter, listings were down 30%, pendings down 22%. But given that for most of the second quarter, in April, May, and half of June, we couldn't even show properties live in New York. We couldn't even do live showings. To only be down 22% in new contracts, I think was rather extraordinary. And then you can see, again, the comparison to the third quarter and fourth quarter compared to last year, how the market just roared back and ending up for the year with closings up 13% and prices up almost 14%. And what that tells you is a couple of things. One is, what we had happen in the third quarter was a lot of pent-up demand from the second quarter that just people want to buy a home, and then they couldn't because they were held back by the pandemic, and then they just came back into the market. But yet listings didn't come back enough because people still weren't necessarily comfortable putting their home back on the market, and that created a surge of demand. And then the other surge of demand, which you alluded to, which was coming from Manhattan, is that people, Manhattan, Brooklyn, other parts of New York City, were turning away from dense environments and looking to move into the suburbs. I think a lot of that was people who were already on the fence or close to the fence of moving to the suburbs. I don't think we drove anybody up to and over the fence. I don't think there was anybody who was a confirmed, I'm going to live on the Upper West Side for the rest of my life, who decided to move to Scarsdale. I think it was a lot of people who were thinking of having kids, already had a kid, the kid was living in a closet, whatever the case may be, and they were right up on the fence and they decided, jump right over it and let's get going. So, but there was definitely a lot of that. I mean, we saw a dramatic influx of people coming from the city. So you add those people to the surge of demand that was held back in April, May, and you end up with this dramatic upswing in sales in the third and fourth quarter, which also, as you said, drove prices up. And prices, as you saw, were up about 13% off last year for the year. Some of that is organic. Some of that would have happened no matter what, because we were moving into a more of a robust seller's market, and rates continued to go down over the course of the year, which helps prices go up. But I do think some of it was artificial in two ways. One is those buyers coming out of Manhattan are the highest relative income buyers that we get in our market. They're paying $3,000, $4,000 a month for a one bedroom. If they own something, they own a one bedroom that cost them $1 million. So they're high-end buyers coming in. So a big influx of high-end buyers, coupled with the fact that the pandemic economic impact hit at the lower income levels more severely than at the higher income levels. If you're working in retail, if you're working in food service, you're working in hospitality, those are not the higher end paying jobs, the upper income jobs. That's who was really hurt during the pandemic. But for a lot of people, the pandemic just meant working from home, which saved you money. You can't go out, you save money that way. Stocks unaccountably went up during this whole process, so they have more money to spend. And so the people who were managing to buy homes in a market like this were also higher income buyers. So I think one of the reasons we're seeing a 13% increase in the average sales price is a change in the mix of properties sold compared to last year. We're just seeing more higher income buyers coming in. It doesn't mean that your home might be worth 13 or 14% more than it was last year. It just means that every market skewed a little bit higher because the people moving there were in the higher part of the income level and were buying at the higher price points. And one of the ways you can tell the difference is that condo prices were not up and condo sales were not up nearly as much as single family homes, which tells you that the entry level market was not nearly as robust as the single family market, which is the higher end market in every one of our regions. So, I think some of it's artificial, but I would say that there was definitely a legitimate appreciation. I just don't know that I would count on 13% again for 2021.
Thorough as always. Thank you, Joe.
Thank you.
Let's turn to William and Paula now. And, based on last year's volume of closings at the end of 2020, was it the same throughout the entire year? Did you pick up? Did it slow down at all? And then I'm just gonna sort of read through some of the other questions and let you each respond to these. New home building has been somewhat limited in the recent past. We're talking about inventory a whole lot. Are you seeing any uptick in new development in subdivisions? And Paul, I think that's a question really directly to you because you work so much within the towns up in Sullivan County. And if so, what types of homes? Are they small? Are they mid-size? Are they these large McMansions of the 90s? And lastly, did did either of you see an uptick in vacation or second homes being purchased? So I'll turn the floor over to William and Paula.
So that specific question about new construction, I would say we've had a modest increase of new construction. Most of it is existing homes, but I have noticed a little bit more of them in the pipeline. I think the last time we got together, Paula was kind of explaining from her perspective, working with the towns, that the change in that market is not as nimble as maybe the rest of the market because of the planning and planning boards and all that. So I think that's probably one of the reasons why we didn't see an immediate change, or at least I haven't experienced it here, predominantly in Orange County. I am seeing more investment properties. Some of the people that are coming up from the city are not completely abandoning the city. I'm seeing a lot of second homes and investment homes that they're getting a toehold up here and spending. It's either a COVID escape or they're just expanding and enjoying the countryside up here.
I agree. I think some of the panic buying is done. We're now seeing more thoughtful buyers. I have seen more clients purchasing vacant land with the thought to build, maybe not build today, but in the near future. And then I have other clients who are building new construction and working with builders in a degree that I haven't seen in a few years in Sullivan County. As far as subdivisions, single-family home subdivisions coming through either of the towns that I work with, which are Thompson and Fallsburg, not really. We're hoping for some. I actually have a client who may be in the process of doing some lake and off-lake homes. Slightly higher end. But so far in the towns and the municipalities in Sullivan County, I'm not really seeing any real subdivision activity at this point. I'm also seeing one thing that interests me is, so I've been practicing here for 24 years now, and the villages predominantly were quiet. There wasn't a lot of sales in and out of the villages. It just didn't happen. And I would say since the pandemic hit, since sometime in, let's say, May or June, there's been more activity in the villages. And what I'm finding is it's folks who had been renting and this is their first home. So they are, for some reason, they're now able to get into the market. And for them, in many cases, they're buying and spending less than they were when they were renting. And they're extremely thrilled to be able to be homeowners.
William, anything to add on that?
Yeah, I'm experiencing the same thing, and generically, I think one of your topics you were talking about was just the volume and pace of the market. Tracking with Joe's chart, the second quarter, I was playing around with fermenting garlic and baking sourdough bread and things like that, and the balance of the year, I have never experienced anything like it in my career. Every process point in the transactions were hyper stressed, and the appraisals took longer, underwriting took longer, attorneys took longer. If those statistics tracked and we were doing 150% over last year in the third quarter, fourth quarter, it's just impossible to maintain the same pacing if you assume a constant staffing. And frankly, if the whole industry is being stressed at the same level, it's not easy to find additional staff to assume that processing, and that includes every piece of it: banking, title, attorneys, everyone, towns processing municipal reports. It just took a lot longer. So it's I've never seen anything like it. It was a very, very difficult 6 months. The last 6 months. I've seen colleagues that, lost 20, 30 pounds of stress weight. Attorneys are coming to closings kind of haggard, and, it hasn't been fun, in a way. But, in a bizarre way, though, we're enjoying a counter economy. We've never done better financially. It's been a robust time for business, but very, very difficult. I think everybody's a little shell-shocked after the last 6 months. Thankfully, I don't know if it's a change in the market or just a little pause with the holidays so far this year. It seems a little more humane. They're still busy, but we personally have managed. We were just a 2-attorney firm, and we hired another attorney, so that's helping a lot. But it feels a little more normal busy. The last several years, we didn't hear crickets in the wintertime like we used to many years ago. But at least right now it's manageable, and it's a little bit, the timelines to get to closing are, I think, returning to a little bit more normalcy.
Sure. And one follow-up question for both of you, Paula, specifically, in your area, Sullivan County, it's very rural. And I'm curious if anyone of the new buyers have had any buyer's remorse once they get into the rural area and realize they're a little bit far out of the neck of things. And what about broadband? Has that made some borrowers think twice about their purchase that they made?
So I don't know if I'd be the first person they would call if they had buyer's remorse, but I might be the second. But generally, I do speak to clients. They may have 1 or 2 questions post closing. I haven't heard anything like that. Broadband is an issue. It's a huge issue, and I know it's a huge issue when for a broker selling a house without broadband. There is, on both ends of the county, actually, in the Mamakating area, there's complete areas that have nothing. And for some folks, it would cost almost for some of the houses that are there, they're going to spend almost half the cost of their house to bring in broadband. The same thing with the western end of the county. And I know our legislators are working on this, but it is a huge issue, especially with this wave of people who expect that they're buying a house, they're going to homeschool or do the schooling through online or work from home, and they can't. I mean, I know just for me, there are days when my Wi-Fi is up and down, and I get bounced out of every Zoom call, every meeting, 2 or 3 times. It is not efficient. I think over time it will either get fixed, or there will be people who say we can't do this.
Yeah, so thank you. I appreciate your insight on that. I know Pattern as an agency, we're looking very, very hard at broadband issue and seeing what solutions are potentially out there, because it does impact everything. So I appreciate that insight. Let's turn over to value and lending with Greg and Bill for a moment. So appraisers and lenders, they're likely struggling to manage the drastic increase in value. And we're going to start with Greg. Let's start with talking a little bit about actually the commercial market, and then we're going to get back into housing. And the reason I ask that is because the commercial market has a lot to do with jobs and employment. And since there's been an influx, out of the southern area of our region in New York City, What have you seen in 2019 versus 2020? Greg?
Thanks, Joe. Thanks for inviting me back. The commercial market is really two stratas. The residential apartment market and the warehouse market are extremely strong in the Mid-Hudson region. Surprisingly, a new apartment complex opened up in Newburgh in the middle of the pandemic, and it filled up in no time. That's just how strong it is. And it's the same going on over in Dutchess County by Poughkeepsie area and that. So the demand for apartments is strong. Investors are paying some really high prices, sometimes a little scary to us appraisers who tend to try and be a little more conservative, but they're going for a lot of money. Warehouses, if you have a nice warehouse, there's unbelievable demand for warehouse space, either to rent. We're now starting to see some buildings that were like the Orange Hollow Tennis Club purchased and turned over to a warehouse. The Tarzio Bowling Alley in New Windsor being purchased to be turned into a warehouse. And there's several more of those stories, but that's the direction things are going because the demand for warehouses is so strong. On the other side of the coin is, if you have a hotel, you're not doing too well. The recreation business, which is one of the reasons, these other buildings are becoming repurposed as warehouse, is those sales the demand for those products is way down. Retail shopping space is down. Owners are having a hard time collecting rent. Our tenants are falling way behind in the retail space, and the owners can't even do anything about it because of New York State's laws. Office space, there's very limited demand for office space now, very limited. And so, if you have to sell your building right now, there's not a lot of potential buyers for those kinds of things. So it's just surprising how different the two are.
Sure.
What ends are.
Sure. And so, the interest rates, when the last time we had this conversation, I think interest rates were just at 3%. And that was 9 or 10 weeks ago, 12 weeks ago. Freddie Mac's interest rate as of yesterday was 2.8%. It had dropped down to about 2.65% for 30-year notes. 15-year notes are 2.25%. I mean, it's almost like it's free money. There's hardly any interest going back to the banks. But because of those drops, and Bill, we're going to get to you in a moment, but I just wanted to hear Greg's opinion on refis with interest rates going that low. Greg?
So the funny thing is, from 9 or 10 weeks ago, when rates were 3%, all these people are kicking themselves now for refinancing back then.
Right.
So actually, the refi market has kind of slowed down just because so many people thought 3 was a great rate and refinanced back then. At least that's from our end of things. But sales, because what Joe was talking about is this 13% appreciation. Well, that's he looks at the overall market, but you get certain pockets where the appreciation is much higher, and it's ongoing, and it's hard for appraisers to show that. If you only have older sales, and I'm talking could only be a 6-month-old sale, it might not show that. So we're always tracking appreciation more in neighborhoods and individual towns than the general thing that Joe's company does such a great job of taking the whole area into account. But so as appraisers, we now have to focus on listings, how long properties are on the market, because if we see that properties are selling in an area really quickly, we have to document and show that that's causing some of this price appreciation. So we apply time adjustments now. And we also look at, pending sales, trying to get information on what pending sales are. So that's always part of it. The other odd thing is that there, and Paula talked about this a little, about investor properties, or people who were buying properties for Airbnb use or things like that. So I just want to say that there should be a little word of caution here. New Paltz is proposing a law that says to have an Airbnb, you have to live in a house 9 months a year. Mm-hmm. So that could cause a lot of people problems if that law became more prevalent throughout the area, because Airbnb buyers have been a big part of our market, especially in the more rural areas.
Sure.
But it's been a struggle for appraisers to come up with the, measuring these appreciations that Joe talked about.
Yeah, and Greg, just one final quick question. Because the values are jumping so much, are you seeing any more requests from borrowers to get a broker's opinion or an appraiser's opinion on value to eliminate the private mortgage insurance PMI on loans?
We went through that more last year, not so much anymore.
Bill, we'll turn the table over to you. Are lenders asking buyers to fill the appraisal gaps, or are banks and their appraisers validating sale prices higher than past sales would support?
It's really a combination, Joe. So okay. I think, as Joanne mentioned already, the buyers, the potential buyers that are coming up from the city are, we typically very well qualified. So they're not necessarily going in for max financing to start. And very often, if there is a bidding war or whatever, they're able to make up that gap, on their own resources. I think there's a combination of reasons for that. I think it's the qualification of the borrower. I think with the change in the SALT deduction a couple of years ago, in the past it used to be, I think everybody would try to maximize what they financed to get the maximum tax deduction. That's now changed. So, it's more in line of what do they need to borrow versus what they have. So that's where I think part of it is. I think, appraisal data, and I agree with Greg especially on the commercial side. I think on the residential side, simply because of the advances in some of the technologies and what we were able to get through MLS in different areas, that some of that data is available a little quicker than it used to be. So there's not always that complete, the long lag of a trail for appraisal data to be able to be there to recognize the market increases. So, we've seen a little better there on some of the increases in the market value through the agent. You mentioned Fannie and Freddie through the agencies and different pieces. With the pandemic and some of the rules they have, they're allowing for more things like some drive-bys and even valuations versus full appraisals, or in some cases an appraisal waiver. So all of that has helped in that regard. There is still, and William mentioned this, there's still a great strain on every part of that to try to get those and get those during a pandemic. Joe mentioned buyers not wanting to let sellers potentially into the home sometimes. Think about having an appraiser come through the home and look at it as well. So the delay isn't always the appraisers. It's sometimes the homeowner in allowing them to come in or trying to figure that out as they go through. But really, the gaps there have been, it's a combination of what has filled them. But I think the overall one is just the qualifications of the borrowers. Many of them haven't gone in for max financing anyway. So when there has been a gap, sometimes that's been taken up, by that. So they ended up with a higher loan to value than they originally thought they would, but they didn't start at the max. So the gap in the appraisal didn't create as big a problem as it would have if they were trying to max finance.
Sure. And, we're talking about such a drop in inventory. And typically when you see a drop in inventory, some of the houses that are in worse condition are on the market. And those homes typically will need, work. So I'm curious, on the lending side, are you seeing more acquisition rehab type loans, or loans that are closing with more dollars in escrow to take care of repairs? What are you seeing there, Bill?
We are seeing a little bit more on the rehab or the construction after the fact. But really a slight increase. It's the same, Joe. Many of the borrowers, again, because of their qualification, are handling those refi, those improvements from their own resources. But some are financing them. And you can see it, we see it, you see it in the marketplace, you see it with the renovations taking place. I think I mentioned the last call, I've never seen so many roofs coming off houses and new ones going on and things, which you can't always see the inside renovations, but you definitely notice when something on the outside of a home is being improved, or trying to get a contractor. So yeah, there's a lot of them that are doing some improvements. Some of them are doing that through financing. Some of them are doing it through a home improvement loan after the fact. Many are using their own funds to do those renovations as well.
Sure. And, since there has been clearly a very big impact on the economy because of the pandemic, and some people are not able to make their mortgage, have you seen an uptick in forbearance requests over the past couple months?
Well, we haven't seen an uptick in the last couple of months. The uptick came, really at the beginning in the March, when everybody talked about getting, payment forbearance and a delay in payments. That's really when the surge came. So it's been constantly going down from there. But that was really because in the initial part, we were set up to really, if anyone told us they had an economic, issue because of the pandemic, there really wasn't a lot of documentation that was required. As time went on, we asked for just a little, each lender asked for a little bit more and a little bit more. So show me a reduction in pay stubs or different pieces. Those are now down significantly. And I mean, they're down to, less than 10% at the peak. In some cases, on our own, we were well over 2,000 loans. We're well under 200 loans, and asking for those deferrals. Having said that, it's hard to get that data, nationally or even locally, because they're not counted, right? They're not really, all those payment deferrals they're not being treated as delinquent loans. Rightfully so, but they're not in any data. So they're not getting reported through as delinquent loans or call reports or different pieces. So they're comparing that data is very difficult because there's not really a data source for it. Having said that, with the group I've talked to and everything else, I think it's about somewhere between a low of 1% and a high of 3% of all all loans that are in that bucket. But it's constantly going down. We've never seen we saw a peak, and every month it's gone down and down and down. We've never seen a resurge of that. In other words, it's always been a reduction of the requests, not a increase in requests.
Sure.
So that's a positive sign overall, but it's really not baked into what we're, if you went back and tried to compare to, the financial crisis, it's difficult because that data, they're not in delinquency data.
Well, it's good news then.
Yeah.
So last week, Governor Cuomo went around and released the State of the State, and his part 4 of the release was primarily about housing and affordable housing. One of the components in his State of the State had to deal with Sony Mae, State of New York Mortgage Agency, and really looking at that agency and changing some of the regulatory requirements to reduce some of the underwriting and make it a little bit less restrictive. So, that's in a proposal for 2021. And they're looking at, some non-traditional credits, some non-traditional sources of income and things of that nature. And I was just curious from the bank's perspective, outside of Sony Mae, has there been any more flexibility on underwriting, or has it been about the same as far as back-end ratio, front-end ratio, percentage down, things like that?
It hasn't changed dramatically, Joe, across the board. And yes, we read the makeup for the Sony Mae. And Sony Mae has 2 components. There's an eligibility underwriting, and then there's a qualifying underwriting, which is different than many other programs, right? Because you have to be eligible to qualify to get a Sony Mae loan, and then you have to underwrite to it. But we've gotten more creative, I think, in some of the ways that we're able to look at data and get income data. If anything, it's been a slight increase in some of the documentation required, not necessarily that it's harder to qualify, We haven't raised qualifying guidelines, and we'll look at that. And we try to also look at pilots for different things to improve for first-time buyers, particularly, or different situations. But many of the agencies and internally, the what I call the pre-closing underwriting has increased. So you underwrite to qualify, and then there's a quality control or a pre-closing that in the past used to say, okay, is the person still employed? And you might be able to call an employer or get a current pay stub. For self-employed borrowers, that's increased because we want to still know that the businesses are open. Has there been a major reduction in income? Has anything changed on those? So some of those pre-closing criteria, a recertification is sometimes required for some of that data, and the longer that period goes, obviously the more that's required. The shorter that period is, if it's closer to the original approval, then the documentation stands. So that's been there. I know we're looking and we're working with, talking with a number of organizations and agencies, some down in Newburgh and, some of the inner city areas, to see if we can find ways to be more creative in underwriting to get more of those borrowers qualified. We haven't seen that come through any of the agencies yet, as a program. They've been pretty standard in those, but we've been trying to be more flexible in some of the stuff that we hold.
Sure. Thank you.
Incidentally, a lot of the buyers that I've seen coming in from the city are unemployed folks from Broadway who have the funds, don't currently have a position. So I'm sure Bill and his company and other banks have to get really creative to deal with that kind of situation. And William, I'm guessing you've seen a lot of contracts where there's sort of the COVID clause that if the buyer loses his job because of COVID, or his position is no longer because of COVID, that's another contingency that some lawyers are putting in to end the deal.
We're seeing that. We're seeing a couple of kind of oddities in contract negotiations in the past 6 months. That's one of them, and that started pretty early on. But the last 4 or 5 months, because of the low inventory and the bit of a feeding frenzy of buyers, it just drove prices, contract prices, to these unnatural levels, where we, typically it's default that not only is there a sort of a mortgage contingency, so essentially if the buyer is denied the loan, they can get out of the deal, get their down payment back. But we usually have a standalone appraisal contingency. So even if the short appraisal wouldn't kill the deal, meaning they would have the means to make up the difference, we just, a buyer generally likes the comfort that they're not overpaying. Not that appraisals are a perfect measure, but generally we usually have that in there. In the wake of these frantic price increases, we have many contracts that sort of assume that the buyer is overpaying, and that they're knowingly overpaying, and they're not going to elect to cancel so long as some of them are just outright waiving the appraisal contingency, so they wouldn't be able to get out of the deal based on a short appraisal, or even a denial of loan based on a short appraisal. And some will negotiate a little bit more of a thoughtful clause where there's a sort of a floor that they're agreeing to. We're going to go forward if the appraisal, at least comes in at the listing price. We're gonna pay the surplus, but not if it's crazy low. But as long as it comes in for your listing price, we'll pay the difference. So all these very goofy contract clauses that we would never entertain a year ago, we're getting in these complex situations.
Very interesting, Paul. Thank you for bringing that up. I would have never thought about that.
Yeah, and Joe, I'd like to make, to Paula's comment, we are seeing that, but realize that some of the changes in regulation that were made after the last financial crisis make a lot of that more difficult. Right? They put in rules about ability to repay and different pieces, which, take away some of the flexibility of the lender in being able to look at someone who's, technically currently doesn't have employment, but has the assets and prove that they have the ability to pay that loan long term. So, there is a regulatory side of this that's tight, that tightened those guidelines after the last financial crisis, which most local banks always joked at and said, we always made sure the borrower had ability to repay. Right. But that wasn't the case for, for some of the larger or national lenders or the brokers. So, but those rules are now there and are, in place. So it makes it much more difficult to do things like that.
Looking towards the closing of our session, I thought perhaps I could get each of your perspectives on what 2021 will bring in terms of three things. First, foreclosure expectations, which we covered in quite a bit of detail with Bill. The second is prediction on getting SALT repealed and what would that do to the market. And lastly, underwriting loosening up on those ratios again from the perspective of not just Sony Mae, but some of the other loan products. And so maybe we'd start back with Joe on this one.
I'm not a political analyst, except in my spare time as an amateur. So what I would say is that we definitely saw the impact of SALT in our market in 2018, 2019. I mean, I did some analysis of it, and markets that were higher priced had an appreciation rate that looked like this over the 4-year period. And the ones that were the higher price markets in Westchester, they went up and then they kind of fell back a little bit, which was the suppressive impact of SALT. But, I think by what we started to see at the end of 2019 was that it was starting to get priced into the market, that people were adjusting to it, that, prices had been held back, but that was at a time that prices, given what rates were doing and given where buyer demand was, prices should have been going up in 2018 and 2019, and they didn't, certainly in markets like Westchester. That obviously changed this year when prices have roared back. And I think at this point, I mean, as a homeowner with a big tax bill in New York, I would love to see SALT repealed from my own personal perspective. But I would just say that I think that, I'm careful to say this because I know that our representatives in Congress are going to try to get it repealed, but it's been priced in. I mean, I think if it got repealed, I think that would do very good things for our market. And I think it would be fair. I mean, I think that the SALT cap was unfair to people in higher tax states. You shouldn't pay taxes on taxes. But I think the market, it withstood that challenge the same way it withstood the challenge of COVID, and it came through. So I think the market will be fine. You also asked about foreclosures, and we talked about that. And the other question was,
underwriting standards. Any kind of loosening up have you seen?
I'll let the mortgage people speak to that. Like that they'll know better than I will. I will say this: what we're going into with 2021 in terms of the market for the first half of the year is going to be 30 to 40% higher than last year in terms of sales. And we know that because it's already big. The open business pipeline right now is about 40 to 50% bigger than it was going into 2020. So first quarter is going to blow out the numbers and probably into part of the second quarter, and I don't see it letting up. So the market is going to stay in a very hot trajectory from a sales perspective, which will probably continue to push prices up. Although I think at some point we'll see the inventory loosen up because there's going to be a lot of year-end attention to prices going up, which tends to shake loose some sellers who wouldn't otherwise be selling, but now they see 12, 13% appreciation. They'll get tempted into the market, which might alleviate some of these inventory problems, because we do have an inventory problem. We're now at like 3 months of inventory in some of these markets, which is really tight. And that might loosen up. But I think sales are going to be robust. 2020 was a record-setting year in terms of sales. And I wouldn't be surprised if 21 approaches that same level.
Sure. Greg, thoughts?
So one of the interesting things that questions you asked was about foreclosures. And we may start to see more of that in commercial real estate on some of these properties that aren't doing so well. I've had some banks now call me and ask me for some input on what's happening to values to certain types of properties.
Mhm.
The other thing that you've talked about in the past is the effect of this no eviction rule. Like I mentioned before, the demand for housing, residential apartments sales is way up. And most buyers do not seem to be too concerned about that. However, we are starting to see some people sell who probably wouldn't have because they become frustrated by this no eviction ruling. And we've actually seen a couple sales of smaller apartment complexes where they had a large number of people who weren't paying sell for a really low amount as compared to what other apartments are selling for. So there is definitely some impact on some of this in the market. I do more commercial work, so I don't know how SALT will affect things. Underwriting is always an interesting aspect. Hopefully we don't go back to the days of the ninja loans, where it was no jobs, no income, no assets, because that led to some big problems in our industry. But we're very busy and things are moving along. So.
Very good. Thank you, Greg. William, Paula, anything to add on 2021 crystal ball moment?
Yeah, one of the questions you had was about foreclosures and on residential foreclosures, and we're still twitching from the few years of short sales that sort of accompanied that. I personally am speculating that we're not going to see it as much in residential, at least, because generally speaking, while forbearance will ultimately end and people will start having to resume payments, and it might cause them to want to sell. But generally speaking, with the advancement of appraised values, there's equity. So it's rare, very rare that a person is going to let it go to foreclosure. What they would do is they'd hire a realtor and sell the house, and they may not have a lot of equity, but generally we're not seeing people upside down like we did the last crisis.
So a quick sale instead of a short sale to get out of danger. Sure,
exactly.
Makes sense.
And maybe that'll help the inventory for a period of time. But I don't see a lot of foreclosures going up dramatically.
Good. Paula, anything to add on your crystal ball for 2021?
Not a real crystal ball, but just watching the way the market is going. We're halfway, 3/4 of the way done with January. I think I had a slowish week the first week of January, and it's ramping right back up. January usually up here is a quieter time, but people are starting to think about, what they want to do in normal years, what they want to do for the summer. So there are people up here looking for summer homes now, and those summer homes, as we know, are stretching into summer weekend, and I think we'll work from home properties. And I'm not sure whether, Joe, it was you who said it earlier, that we still have people who are keeping their feet in Manhattan, but coming here for more extended periods of time. So they're keeping their rental or they're keeping their condo unit, but they're coming here. And we have also, there are folks in Sullivan and Ulster counties, for example, who are selling their homes. They didn't think that they were going to do it, or they thought they would do it 5 years from now, but the price is right and they're ready to sell. They don't have anywhere to go, and that becomes an issue.
Yeah. All right. Thank you, Paula. Anyone else? Any other comments, thoughts?
Yeah, so I do agree with William on the foreclosure side. I think that the increase in values will potentially, keep that down. Realize there hasn't really been an increase in the number of people in that category because of the payment deferrals. But one of the things to qualify for the payment deferral is you had to be current as of December of 19. In other words, you couldn't be delinquent and qualify for a payment deferral. Because you can't say that the issue was caused by COVID because the pandemic it hadn't taken place yet. So it's really that the only ones in that backlog are really the ones that were there, starting in December of last year. We haven't added to that backlog, so I think that'll be down. I think the SALT deduction will go through. I don't think it's going to have as big an impact as we would like, because I think we'll also likely see increase in income taxes on that same group on both a federal and state level. So I think the net effect of it isn't going to be as positive as it would have been if it had been revealed earlier on. I do think the local market, I don't think there's going to be a drastic change, Joe. I wish we could say there would be drastic changes in underwriting guidelines, but I agree with Greg. I don't think we're going to go back to the days of the ninja loans and different pieces. So there may be some tweakings, and I think there'll be some pressure for it on the, on the first time buyer and on the lower sections. But really, in my mind, it's not about getting the person in the home, it's keeping the person in the home, right? So if you stretch too much, and that's what I think happened, we stretched too much to get them in, and we lost sight of, that ability to pay long term. So there's only a little bit that may be able to be done, I think, in that before it becomes dangerous, that we put people in homes and then we do end up with a problem afterwards. So it's that's within the piece. Lastly, I do think our local, I think our local economy and our local real estate market will be good. I think we're bucking the trend in a lot of areas. I know particularly, in an unemployment rate, our region, has been about a 5.32, at least as of November. That compares to 6.4 nationwide and 8.10 for New York State as a whole, right? Because it includes now New York City and the other pieces. So we've been a little pocket, and I think that'll be strong going into 2021. So I'm kind of hopeful for it for our region.
Thank you, Bill. Appreciate those comments as well. We've talked about a lot of things. We covered about 50 minutes worth of pretty strong content here. And without further ado, I'd like to close out and thank you all once again. And a big thank you to our webinar sponsor, NeighborWorks America. And I'd like to take a couple of seconds just to thank our Patterns Center for Housing Solutions investors, including Howard Hanna Rand Realty, the Carney Group, Community Preservation Corporation, RUPCO, Hudson River Housing, Leviticus Fund, Baxter Development, and TD Bank. So thanks again, and we're going to be back next month and continue our conversation with a number of other topics in housing. So thanks, and have a great day, guys.
Be part of the solution. Join. Become a member. Subscribe. Join our mailing list to stay in the know. Attend our events and virtual panel discussions. Sponsor. Become an event sponsor to support our programming. Participate. Get involved in a pattern initiative like Fellows and Lift HV. Invest. Support pattern initiatives you're passionate about through an annual investment. Donate. Make a charitable contribution to support Pattern's work. Connect with us.